Hi everyone, can you hear me? Hi Alejandra, can
Hi.
you hear? Hi. Okay, let's wait 1 more minute and start afterwards. Can you see my screen?
Yes.
Okay, perfect. I think we can start. And just last thing I want to see. Okay. How was the exam?
It was good.
Okay.
It wasn't as bad as I thought it was going to be.
Okay, perfect. I give 75 minutes for 25 questions. I mean, I think it's more than enough, but I'm not sure how hard that was, or it was easy, or it was okay. I'm not
It
sure.
was plenty of time.
Okay. I think I'm just looking at whether someone's here. Okay. Yeah. Okay, that's what I want. Okay, let's start. As you know, for the Vic 3, we need to cover chapter 8 and chapter 9. Chapter 8 is about risk and its measurement. It's a very important concept for finance. You will see risk and its measurement all the time in the finance literature, and also if you're a trader or if you want to invest in stock market or any securities market, you first look at the risk, and then uh, you compare the risk and return. So first part of this chapter is talk about the risk and its measurement, and then later on we look at the risk and return measurements. And while an investor investing in a security, we he or she try to compare the risk and its return, and then investing it. Let's proceed. So this is the agenda of the chapter 8. As you may remember, I'm showing the finance diamond because we should know where we are in the concept. And then we'll look at the return on investment, risk and measurement of risk, standard deviation, risk reduction through diversification, measurement of risk data, which is very another important concept that we need to know, capital asset pricing, model CAPM, and required return. And we will solve some problems that hopefully help quiz today and exam, second exam, and quick wrap up. So we already look at these figures, the finance diamond. We have the direct, indirect, and direct transfer, and we already look at the perpetuity, the present value of the stocks or future value formulas, perpetuity, and any of the formulas. Now um, we look at the return formulas and risk measurements. And yeah, let's proceed. So return is what is earned and investment. So return depends on income and capital appreciation. There are three types of return. The first one is realized return, which which is basically the past return. Let's say what was the return of IBM from 2014 to 2015. This is realized return. Expected return is the refers future, meaning that we take into account the probability and the return. So this is the probability of each outcome happening. I will explain deeply in these concepts while we are solving questions. And the third one is required rate of return, RRR, which is return required to a certain level of risk. So the relationship between risk and return is important, and the higher the risk, the higher the required return. Okay, so competing historical returns. This is when you compute the return, we need to take into account the dividend and the price level of the stocks. So this is the main formula that you need to use while you computing the return. So the first part is the dividend yield. The second part is capital gain. The overall gives us the return. So let's solve a problem. So Angel Corporation has a current stock price of $20 in 2015 and pays a dividend of $1 in 2016. Its stock price right after paying that dividend is 22. What is the realized return of Angel? How much of Angel's realized return is composed of dividend yield and how much of capital gain? This is exactly what I've shown. We mainly will solve. We'll compute the first part and second part, and we just sum up them and find the return. So let's solve it. So the question already gave us the dividend payment at time 1, which is $1, and the price level of the stock is $20. We need to compute the capital gain part, and in order to compute the capital gain part, we look at, this is important, we look at the T+1 price level minus price level at time t divided by price level at time t. So it gives us capital gain part. So what was the price level at T+1? It was $22, which is given by the question. So we have $20 at time t divided by at time t price level 20. So we just basically compute the aggregation, and which is 15%. So what is the dividend yield? So dividend yield is the first part, which is 5%. What is the capital gain part? The second part of the equation, second part of the computation. So this is 10% capital gain, 5% dividend yield. The total is 15%. What is the next return is expected return. In order to calculate expected return, we need to hold on. I need to make sure. Am I recording this? Am I recording this? Yes, I'm recording. Good. So the next return is expected return. We need to use the probability and the return. So in this calculation, we have P and R. P represents a probability of each scenario to happen, and R is the return of each scenario. I will explain. It will be much clearer when we solve the question. So let's solve the question. The problem 2, normal economic conditions occur 60% of the time. This is probability. There is a 20% chance the economy will grow. This is another probability, 20% chance the economy will grow, 60% chance normal economic condition, and 20% chance recession. So when you make a business investment and you believe that you make a 10% return, however, if the economy goes bad, you will believe that you will make 5%. If the economy goes well, you will believe you will make 20%. So we have returns for each scenario, three different scenarios, and we have probability for each scenario. So what is expected return? The calculation is very simple, and we are using the probability and return, and just we sum up them and find the expected return. How can we do that? Just this calculation means that probability 1 multiplied by return 1 plus probability 2 multiplied by R2 and plus probability 3 multiplied by return 3. So we just find the calculation. This is a 20% chance we return 20%, 60% chance that we have 10% return, 20% chance that we have 5% return. So the calculation is just to sum them up, and we find 11%. This is expected return under the condition of the probabilities that we have for each scenario. If you have any question, just anytime, just interrupt me, just ask. I try to explain um, your question. Okay, and okay, at first look at risk and return. Consider how $100 would have grown if it were invested in each of the following from the end of 1925 until the beginning of 2020. So we have different um, categories. Let's say we have Standard & Poor's 500 index, small stocks, world portfolio, corporate bonds, and treasury bills. These are different capital market instruments, right? And we try to, in the next slide, we will see the returns from the beginning of 2019-25 at the end of the 2010. As you see, we have different figures, right? As you see, for the small stocks, we have higher return. This is the value of the investment. The performance is higher than the other investment instruments. Let's say if you look at the small stocks, if you invest $100 in 1925, $100, you will get $15,000 in 2010 if you only invest small stocks. This is the portfolio that includes only small stocks. What if you invest S&P 500 index? S&P 500 index only includes top 500 companies, big companies in terms of their capital market capitalization, or simply put, their size. This is the largest companies in the US. It includes Apple, Microsoft, and other big companies. And if you invest those big companies in 1925, only $100, you will get this amount of money, which is, by the way, this is not 1,000. This is 15 million. This is 238,000. And so the main outcome from this figure is, if you invest in small stocks, which involves higher risk, and you get high return. If you invest S&P 500, world portfolio, corporate bonds, treasury bills, CPI. Treasury bills is includes at least risk, and let's see what is the return that we have if we invest treasury bills. This is the almost lowest one because it includes a lower risk. So the main outcome is, the lower the risk, the lower the return you will get. The higher the risk, the higher return you will get. Let's skip this. This is just a table that shows the same idea, like small stocks, S&P 500, corporate bonds, and treasury bills. If you invest in small bonds, you will get, say, 65% return in just before the Great Depression. But in the Depression time, which starts in 1929, your performance is way worse than other instruments. Let's say the treasury bills. This is the lower risk, and your return is very stable. As you see, in 1926, your return is 3%. 1927, 3%. 1928, 4%. You don't experience any negative returns, because the risk is so low, and you get very stable income. But if you look at the small stocks column, you will see your return is very high in 1928 compared to the treasury bills or corporate bonds, even S&P 500. But in the recession time, in the bad times, your return is way worse than other capital markets instruments. And another figure just shows the comparison of the stock market performance in terms of the British market or American market. In British market, you'll see this is the different crises in history, and it is the comparison of the British market and American market stock market performance. Let's look at just 1929 and between 1929 and 1933, which is the Great Depression time. The American market way worse, worse than the British market. But in oil crisis, British market performed worse because this is negative sign, negative 40, negative 60, negative 80. The British market performed worse than American market. So this is just a new figure that we experienced in coronavirus impact on global stock market since the start of the outbreak. As you may remember, the outbreak just starts early March or late February. This is Dow Jones for the American stocks. I think it is the Japanese stocks, and the FTSE is the British market. So as you see, the British market performed worse than Japan or American market. There could be many reasons behind this. Let's continue. Risk. Risk is the uncertainty associated with earnings to expect return, and realized return may differ from expected return. So we can divide risk in two parts: unsystematic risk or systematic risk. Unsystematic risk means the risk can be diversifiable. Systematic risk means that the risk cannot be diversifiable. It's non-diversifiable risk. So the definition for unsystematic risk is risk associated with individual assets such as the firm-specific factors. This unsystematic risk can be reduced through construction of a diversified portfolio. What do we mean about this? Mean by this? Let's say Apple stock. Apple stock. They are producing their chips. They were producing their chips in China, and the China factories are closed because of the coronavirus. No one can produce chips in the China factory, so that's directly affect the company, Apple company stocks, and this is unsystematic risk because they're producing their supply chain mainly depends on the China production line. So this is the risk that directly associated with the Apple company, Apple stock. What is systematic risk? Risk that associated with the fluctuations in securities prices or other non-firm specific factors cannot be reduced through construction of a diversified portfolio. Systematic risk is just a risk that applicable for everyone. Let's say a risk coming from weather, earthquake, or other like coronavirus crisis affect everyone, right? You cannot diversify your risk, putting your money for different sectors if the risk comes from if the risk affects everyone. This is systematic risk. It's affect everyone, every company, every industry, and you cannot diversify your risk by investing other companies. So this is not company related. Unsystematic risk is directly company related risk. Okay, let's dive into. Okay, we have total risk. We can separate total risk into systematic risk and unsystematic risk and systematic risk. What is unsystematic risk? This is diversifiable risk, which links to the business risk and financial risk. Systematic risk is non-diversifiable risk, and we can just divide into 5 different parts. Links to market risk, interest rate risk, reinvestment rate risk, purchasing power risk, and exchange rate risk. Let's go next slide. So same explanation. So in the unsystematic risk, we have business risk, which is risk associated with the nature of the business. As I remember, I gave the Apple company risk, the nature of the company risk. So it highly links to the nature of the business. The financial risk is associated with how a firm chooses to finance its assets. The debt ratio of the company, if it is very high, it's high. That means the financial risk is very high for that company. Systematic risk, we have 5 different categories. Market risk, which is associated with the fluctuations in securities prices. Interest risk, which is associated with the fluctuations in interest rate. Reinvestment rate risk, which is associated with the reinvesting earnings on the original investment at a lower rate than was initially earned. Purchasing power risk, uncertainty that future inflation will erode the purchasing power of the assets and income, which is links to inflation. Purchasing power risk. Exchange rate risk is the risk of loss from fluctuations in the value of the foreign currency. if the value of the currency is, you're selling your product in US dollars, if the US dollars depreciate dramatically, the value of the currency depreciated, and your income generated from the sale will be lowered. So this is exchange rate risk. And the other one is sovereign risk, which is associated with the possibility that a country government will default on its debt obligations. Remember Venezuela, Euro crisis, or Greece crisis. It also affects the companies in that country. If the sovereign risk is very high for Greece, Portugal, Italy, or European countries, or Argentina, Venezuela, or Brazil, other companies, it also affects the companies operating in that countries. Okay, let's proceed. So we have two measures for risk. The first one is standard deviation. The other one is beta. These are the very important concepts for you, for the quiz and for the exam. I was explicitly saying this because I conducted a survey, and some of our class participants saying that it should better to refer some concepts when I'm explaining in the review sessions, and I need to refer these. Some of the concepts are important for the quizzes and exams. Anyway, so two important measures: standard deviation and beta. And how can we calculate the standard deviation and beta? These are the very important problems. So we need to know how to calculate standard deviation, and we need to know how to calculate beta, and what is the meaning of beta? What is the meaning of standard deviation? So as you see in this table, we have return years, year 1, 2, 3, 4, 5, and 10, and 9 through 9. And return stock A is, for stock A, return for year 1 is 13.5%. Return year 2 is 14% for stock A. Return 3 for year 3 is 14.25, and it goes on. And the average return is, we just sum all 9 returns here and divide by 9. This is the average return, right? Simple average calculation. Similar thing, we have return for stock B for time 1, and the return stock B is 11%. For year 2, 11.5%. It goes for the 9 years. And as you see, when we sum them up and divide by 9, then we will find 15%. Same average return. But how about the fluctuation? Like you see, this is 11%, 11%, 12%, 12%, almost stable. But if you look at here, 13.5, 14, 14, 15, 16. Maybe stock B is more fluctuated. Let's see the this figure. What is this figure? This is just simply, we put all the returns values on horizontal line, which is X line, and on the Y line, the vertical line, we have the frequency. How many times stock A has 13% return? How many times stock A have 15%? How many times the frequency? How many times stock B has 11%? I didn't show the frequencies. It should be 1, 2, 3, 4, 5. This is the number of frequency. So as you see, for stock A, we have this figure, and for stock B, we have a very flat curve. What does it mean? So let me ask this question: which of the stock involves more risk, in the sense that standard deviation? So when I say risk, means standard deviation. So I'm asking which one involves more risk. In other words, which one has higher standard deviation? stock B or stock A. Of course, stock B has high standard deviation. Why? Because as you see, this is the average of returns, 15% for all of them. This line shows the average percent. Deviation of stock A is so small. You see, the deviation only minus maybe 1.5 and plus 1.5. So the deviation for stock A is just this level, but stock B, even we have same average return, the deviation is so high. It goes 11%, it goes 11%, or it goes more than 18%. So the deviation is so high. So the risk is much higher in stock B than the stock A. So how can we calculate standard deviation or variance? First, we calculate average return. Average return is just sum all the returns and divide by how many returns do we have. If we have 3 returns, divide by 3. If you have 9 returns, you just sum all the returns and divide by 9, and you find average return. And then we subtract the average return from the individual returns. This one, we find this average return, and we subtract average return from individual returns, return 1, we subtract, and we square this difference, plus second return minus average return, we square this difference, plus, and it goes up to the t. T is just how many returns we have. If we have 9, just it goes through the 9, and we have 9, return 9 minus average return, square this difference, and we just sum them up, okay? And the last step, we need to divide this summation minus 1, t minus 1. T is 9 if you have 9 returns. So we divide this 9 minus 1, 8, and we find variance, okay? So how can we find standard deviation? In order to find standard deviation, we just take the square root of the variance term, and we find standard deviation of this stock. So let's solve a problem. Using the data below, what is the standard deviation of S&P 500 returns for the years of 2005, 2009? How can we calculate this? Okay, first step, we need to sum them up. Let's solve this. We need to sum them up and then find the average. First, we compute the average annual return of the S&P 500 during this period as 3.1%. So the average, what is 3.1%? This is the average value. If you sum them up and divide by 5, we will find 3.1%. And then we will have all of the necessary inputs of the variance calculation. Just we put the average return here, and in the first year we have 4.9. In the second year we have 15.8% return. In the third year we have 5.5% return, and so on. And we take the difference, square the difference, and sum them up and divide by. We have 5 returns minus 1. We divide this summation 4, and we find this is the variance. So how can we find the standard deviation? We just take the square root of 0.058 and find the 24.1% standard deviation. That's it. So you may ask me, hey, this is so difficult to compute. I don't want to spend time to put all the numbers. It's so confusing. You know, it's too much calculation. Okay, you can use your financial calculator, and I strongly recommend use your financial calculator and have to use it. I put a link here in YouTube. You can find the different YouTube videos regarding this standard deviation calculation. I think it's very simple, and the guy explaining how can you use your financial calculator in order to find standard deviation. Simply, you will use second button, and you will use data. As you see, data, you just push the second button and push the data, and you will enter all the values in the screen, 14.9, all the returns, and then you will use again second button and set, and you will find the standard deviation value. Super easy. Just watch this. I think 2 minutes explanation. You'll just simply. I hope you will simply understand how can you calculate the standard deviation by using a financial calculator. Okay. What is diversification? So risk reduction through diversification. Unsystematic risk declines as more securities are added to the portfolio. You can reduce your unsystematic risk by diversifying your portfolio. Diversifying means that you're putting more stocks in your portfolio. You're not holding one stock, let's say Apple, which is technology stock. You can add Apple, Amazon, Tesla, Microsoft, Google, Alphabet, and the other companies. Also, these stocks belongs to tech companies. You may also add other stocks, which is different operating different industry. Let's say health, biotech, AI, technology, other technology companies, or service companies, and in order to diversify your portfolio. This is diversification. So by applying diversification, you can reduce your unsystematic risk. So you're adding more companies, more stocks, and you can reduce your portfolio risk until the level of here, which is systematic risk. You cannot diversify systematic risk, and you can reduce your unsystematic risk only the level of the systematic risk by diversifying your portfolio. So systematic market risk is not affected by diversification. This part, it doesn't change. Even you're adding more stocks, more securities, treasury bills, options, stocks, real estate, whatever it is, ETFs, exchange traded funds, gold, Bitcoin. It doesn't matter. It doesn't matter which sectors you're adding. You cannot reduce your systematic risk, but you can reduce your portfolio, your unsystematic risk. Okay, so you remember we have. Okay, how can we calculate a portfolio return? So we don't have only one stock. We have different stocks. We have, let's say, two stocks, or more than two stocks, three stocks. So we need to use the weight and the return of each stock. So this is the calculation. This is portfolio return. This is the weight of the stock. This is the return of the stock. So RP represents return of the portfolio. WI is the weight of each stock or asset in your portfolio. RI is the return of each stock in your portfolio. And the risk of the portfolio is the standard deviation of the portfolio, and depends on the risk of the portfolio depends on each asset's variability, each asset's weight on the portfolio, and the correlation among the returns. Okay, let's solve a problem. I think problems, when you solve the problems, it will be much easier to understand. So this is the problem that we need to calculate portfolio return. So we have three stocks. We have returns for each stock. For, let's say, stock A, we have 8.3%. For stock B, we have 10.6%. For stock C, we have 12.3%. And weights. So it should be 100 in total, because you have some amount of capital, let's say $1 million, and you're investing only three stocks. And the weights, you need to invest all of them. And you're investing only three stocks. And the weights are 25% stock A, 25% stock B, and 50% stock C, and overall 100%. You're investing all your capital. Okay, so how can we calculate the portfolio return? It's easy, and we're using the formula that we saw here. So we just simply multiply the weights, and the return. The weight for the first stock is 25%, and the return was 8%. This is, let me say 8%, 8.3%. This is 0.083. This is the return. This is the weight, 25% weight. And then, and we have again a second stock, stock B, which has 25% weight. What is the return of the stock B? 10.6%. What is the weight of stock C, which is 50%? What is the return for stock C? Is 12.3%. So just simple multiplication. We multiply and add the multiplications, and we find 10.88% for portfolio return. Historical risk and return of stocks. This line shows the standard deviation of returns. In other words, risk of the each investments. This is the investment category. So as it's not surprising, if you invest in small stocks, you're living with high risk. S&P 500 is lower than small stocks in terms of risk. Corporate bonds, even lower. Treasury bills, even lower. Okay. What is the time? Oh, 37. Okay, we spent 37 minutes. I can speed up. Okay, same figure as you see. Volatility means the standard deviation, and the vertical line shows the average return. If you invest in treasury bills, your return is very tiny, just 5%, and also your volatility standard deviation is also very low. So low risk, low return. Let's go to small stocks. This is the index portfolio. As you see, the standard deviation is more than 40%, and return is higher than 20%. So high risk, high return. This is the individual stocks, and similar concept, similar relationship. Okay, let's go. Beta. Another concept is beta, a relative measure of the systematic risk. A beta coefficient is an index of risk that quantifies the responsiveness of a stock's return to change in the return on the market. It measures a stock's return relative to the return on market. So I will explain deeply what the beta exactly means. So, but we need to know beta measures a stock's return relative to the return on the market. Let's say S&P 500 index. This is just a sensitivity or the measurement of measurement that shows the relative measurement to the return on the market. Okay. However, it doesn't tell you anything about how the market will change. It shows only the sensitivity of that specific stock relative to the market return. And the measures of a volatility of stock relative to the market. Okay, let's see what does it mean. Well, if I say you, okay, the beta of Apple company is 1, or the beta of Tesla is 1.5, what does it mean? It means if the Apple company has beta 1, it means Apple stock returns has same volatility as the market return, as the, let's say, S&P 500. If S&P 500 today rise 5%, S&P 500 rise 5% today. If the Apple beta is 1, we're expecting 5% increase, 5% increase in Apple stock. Let's say if the beta is more than 1, let's say 2. If the Tesla's beta is 2, that means if today S&P 500 index increase 5%, we're expecting 10% increase in Tesla because the beta is 2, the market return is 5. Just we are expecting higher return in the company, in the Tesla company. Again, if the beta is less than 1, stock return is less volatile than the market return, which means this is this company stock is defensive, meaning that defensive meaning that we get less return if the market, S&P 500 market goes very well, but vice versa. Conversely, we have less loss if the S&P 500 decrease sharply. Say if the S&P 500 decrease 10% today and the beta is 0.5%, the stock return only decreased 5% because this is 0.5. S&P 500 decrease 10%. We only expect 5% decrease stock return, decrease of stock return. So that's why we call it defensive. Okay, this is the same concept, beta coefficient, and AB shows the market return. This is the slope of the market return. The slope is 1. If the stock is aggressive, which means beta is more than 1, we see the beta is more than 1. This is beta. Here is beta is 1. In this line DC, the beta is more than 1. Same. Another example. We have market line, market beta line, and this is 1. Beta is 1 for the FE line. For the stock, the beta is less than 1. The beta is less than 1, and as you see, the stock return is less than the market return. Okay. Okay. I need to speed up. Okay, estimation of beta. There's a simple calculation. The individual observations are summarized by linear regression analysis, which computes the y-intercept A and the slope B for the following equation. So we have returns on a y-axis, and we have interception. Let's say A. This is linear regression model, and we have A. We need to sum the data plus return on market. So we have return on market. We have some interception point and return on stock calculation. So return on stock equals to A plus beta multiplied by return on market. The slope beta is the beta coefficient. Okay, let me explain in the following example. So this is the beta line. So we have different returns. Let's start from this point. Okay, we have return on market and we have return on stock. Return on market RM, which is here, RM. Return on stock is the RS, which is here. So we have different points. Let's say here, 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 here. So in linear regression, as you may recall, we have linear regression line, and the intercept point is almost 0. You're seeing it's 0, but it's not 0. It's almost 0. And the line is almost 1. This is 0.98, and the beta is 0.9856. So the intercept point is A, the beta is the slope. And this regression equation can be used to forecast the expected return on the stock. And if one anticipates that the market return will be 20%, then the stock should yield on return of 19.7%. Simply, we just put the beta and return on market is 20%, and we find return on stock by using this formula. Everything will be given in the question. If someone asks you, hey, just calculate me what is the return on stock, conditional on conditional on the beta of the stock and return on the market. So let's look at the problem. I think we have some problems at the end of the chapter. So we call it capital as a pricing model, and the model used in the valuation of the asset that specifies the required rate of return for different levels of risk. And capital as a pricing model specifies the relationship between risk and return. And CAPM, capital as a pricing model, makes the theoretical trade-off between risk and the return operational. This is important. this is extremely important slide for your quiz and for your exam. Know this, know these concepts. What is risk premium? What is market risk premium? This is different. Let's look at this slide. Risk-adjusted required rate of return on a stock. So risk-adjusted required return on risk-free plus risk premium. So risk premium is beta multiplied by market return minus risk-free rate. Okay, just a simple explanation. We have stock return on the left side. On the right side, we have risk-free rate return, which is treasury bill return, plus beta multiplied by the market risk premium. What is market risk premium? This is the return of market minus the risk-free rate return, which is a treasury bill return. So the difference between market return and the risk-free rate return gives us a market risk premium. This is this typo, premium, market risk premium. And the risk premium is the whole concept which includes beta. So beta multiplied by the market risk premium gives us the risk premium. Okay, RF represents risk-free rate, beta represents the beta of the asset, RM is the return on market. Usually we are using S&P 500 return. So the risk premium is additional return required to bear the non-diversifiable systematic risk associated with the stock. And market risk premium must be adjusted by the market risk associated with additional stock using beta. And this is the simple formula. You have to know this, you have to understand this, and do not confuse the terms, the market risk premium and risk premium. Okay. Risk premium, we are adding beta, and market risk premium only the difference between market return minus risk-free rate. You will be asked. You will be asked for this concept. Okay. Capital asset pricing and required return. So we have capital asset pricing model, and this is the regression line. So we have stock return, risk-free rate, a market return minus risk-free rate beta. This is the beta coefficient and required rate of return for this calculation. So let's solve the problem. As stock, you want to invest as a beta coefficient of 0.6 if the risk-free rate is 2% and the return on the market is 8%. What is the required return on this stock? So everything is given. So if you know this calculation, if you know this formula, you just put the values on this formula. That easy. And the beta coefficient is 0.6%, risk-free rate is 2%, market return is 8%. What is the required rate of return on this stock? And is this stock more or less risky than the market? Let's calculate. So the formula is we have RS, which is stock return, RF, risk-free rate, return on risk-free rate, and beta is the beta coefficient multiplied by the market risk premium. So we have market return 8%, risk-free rate 2%, beta is 6%, risk-free rate is 2%, and we simply calculate 5.6%. So what is the beta for this stock? 0.6. The question is asking, is this stock more or less risky than the market? How can we find? Just you look at the beta. If the beta is less than 1, that means the stock is less risky than the market. If the beta is higher than 1, it's simply this is more risky than the market and the stock is aggressive. Now this stock is defensive because beta is less than 1. Another question, your estimate of the market risk premium is 6. You see, market risk premium. You have to know market risk premium. 6%, the risk-free rate is 4%. General Motors has a beta of 1.6. According to the capital asset pricing model, what is the expected return? So the question already gives us the market risk premium. So we put, this is the market risk premium here. So we put the 6% here, and we have beta 1.6. We have risk-free rate 4%. So the required rate of return is 13.6%. Okay, so we finished chapter 8 in 50 minutes. It's a very long overview, but I think it's very important and it's very useful because every time you will see market risk and return calculations, and yeah, it's important concept. So let me open the second chapter, chapter 9. Okay, I will be quick. I will spend maybe 20 minutes or less than 20 minutes for this chapter. Okay, let's start chapter 9, analysis of the financial statements. This is the agenda. This is the finance diamond. So where we can find financial statements. This chapter just explained where we can find the financial statements and what is the financial statements are. So the financial statements are accounting reports issued periodically to present past performance and a snapshot of the firm's assets and the financings of those assets. All the market participants, including investors, financial analysts, managers, other interested parties such as the creditors, rely on financial statements to obtain reliable information about the corporation. While if you want to invest any document, any stock or securities, capital market securities, you first simply look at the financial statements, and we call it fundamentals, fundamental of the company. Okay, which financial information we get? 10Qs and 10Ks. What are those? 10Qs are the quarterly basis. Q represents quarter, and K is annual basis reportings. So public companies must file financial results with the Securities Exchange Commission. Securities Exchange Commission is the regulatory body that enforces public companies to file their financial reportings, and this is compulsory for public companies, but it's not compulsory for private companies. Private companies does not need to file their 10Ks or 10Qs. The annual report with financial statements must be sent to their shareholders every year. Financial statements must be reliable, understandable, and comparable. Audit firms, audit the accuracy of the financial reports, and generally accept the accounting principles and set by the Financial Accounting Standards Board to provide common set of rules and the standard format of the public companies reports. So every company, every public company in the United States needs to file their financial reports according to generally accepted accounting principles, and corporations are required to hire an auditor like KPMG or PricewaterhouseCoopers, I guess, if I'm not wrong. Some audit firms, some accounting firms, they hire the auditors to check their annual financial statements, ensure that are prepared according to the standards, accounting principles, and provide evidence that information is reliable. Okay, so what are the financial statements? We have four main financial statements. The first one is balance sheet, second one is income statement, the third one is statement of the cash flow, and the fourth one is the statement of stockholders' equity. Okay, so what is balance sheet? Balance sheet enumerates what a firm owns, the left side, assets, and owes, liabilities is shown in the right side, and it's the net worth of equity. So on the left side, we have assets. On the right side of the balance sheet, we have liabilities and equities. All assets must equal to liability plus equity. Assets, what are the assets? Items or properties owned by the economic unit. Liabilities, what an economic unit owes. If a company has property, equipment, machines, cars, all kinds of equipments they're using in their operations. It's assets. Liabilities, how the company finance those assets, can be loans or can be equity. And stockholders' equity, firm net worth, the difference in firm's assets and liabilities. This is important. You needed to know this equation, which represents assets equals liabilities plus stockholders' equity. The two sides of the must be balanced. Two sides should be equal. So let's look at the balance sheet. This is a very simple balance sheet of a company. You see 2010, 2009, 2010, 2009. This is the asset sides, this is the liabilities, and stockholders' equity side. These two numbers should be, the total aggregating number should be equal in both sides. As you see in 2010, the total assets is 170.1, and the total liability and stockholders' equity in 2010, which is 170.1. These are equal. Okay. As you see, we have current assets, long-term assets, current assets, cash, account receivables, inventories, long-term assets, property, plant, equipment. There are different subsections of assets. Also, we have liabilities part, current liabilities, long-term liabilities, account payables, and not payable is a short-term liabilities. They are payable in 1 year, and the long-term liabilities is they are payable in more than 1 year. So they call it. We have different subsections on the liability side. Last part is the stockholders' equity. This is the common stocks and paid in surplus. If the company is a public company, you have common stocks part, and you have retained earnings accumulating each year, or decreasing each year depending on the performance of the company. So this is the total equity. When you calculate total liabilities and total equities, you will get 170, and which is equals to the total assets. Okay, and the current assets, as I explained, I just skip here. Details you can read on your own. Explanations. Let me correct myself. Yeah, the 12 months. Okay, and equity, treasury stock, retained earnings. Please read those items. And again, same thing. It should be equal. Assets should be equal. Liabilities plus equities. So these are important concepts that you need to know. Let's start with book value of equity. What does it mean? It means the net worth, or from an accounting perspective, book value of equity is assets minus liabilities. You will find the value of the equity holders, the value of here, the stockholders' equity, and what is the book value per share. So you calculate book value of equity divided by number of shares outstanding. Market capitalization, market cap, in short, it shows the value of the company or the size of the company, and the market price per share times number of shares. How can we calculate? We look at the price of the company, like Apple stock 330 per share, number of shares, let's say 10 million. So you multiply 10 million by the price per share, you will find the market value of the equity, or market capitalization value. Same thing. Okay. The market to book value. So we have market value of equity and book value of equity. You just divide market value of equity by market over book value of equity, and you'll find the market to book ratio. Okay, net working capital. Net working capital is the difference between the current assets and current liabilities. Liquid ratio is the current assets over current liabilities. Quick ratio is the current assets minus inventory divided by current liabilities. Debt ratio is the total debt divided by total equity. Debt ratio is total debt divided by total assets. So you don't need to memorize all of them. I already prepared for you the definitions or ratios table. You don't need to memorize them, but you need to understand what does it mean net working capital. How can we use it? Where we can use it, and what does this concept mean? Just no memorization. Just understand the calculation or the understanding of the meaning of this. The enterprise value is the market value of equity plus debt minus cash. So it shows that the corporation value, we are taking into account the market value of equity. We include debt, but we exclude cash. Okay. Problem 1, just quickly solve this problem. If a global corporation has 3.6 million shares outstanding, and these shares are trading for a price of $10 per share, what is the global market capitalization? Market cap is multiplication of price by the number of shares outstanding. So you will multiply 3.6 by $10. How does the market capitalization compare to Global's book value of equity? We need to calculate the book value of equity. And what is the Global's book market to book ratio? Okay, let's solve this. So what is the market cap? So we multiply 3.6 million shares, multiplied by $10 per share. We have $36 million market cap. What is the book value of equity? So this market capitalization. Okay, we need to look at the book value of equity. Let's go to the here. As you see, the book value of equity is, let me find, yeah, the book value of equity is, we need to look at for 2010, Global Corporation book value of equity is 22.2. This is total shareholders equity, meaning the book value of equity, okay? Very important. We need to familiar with the method that we can find the each components of the balance sheet. So where can we find the total assets? Where can we find current liabilities, total long-term liabilities, short-term liabilities, or stockholders' equity? You should know the place of these concepts, these items. Okay, let's go back to the calculation. We already know the book value of equity, which is 22.2 million, and the Global must have source of the value that do not appear on the balance sheet. This may include, okay, yeah. So explanation. So we have, yeah, book value of the company is 22.2 million, but the market capitalization, the market value of the company is 36. You think it's weird? I mean, why? Why the market value of the company is 36, but the book value, the accounting value of the company is 22, which is the market cap is higher than the book value of company, more than maybe less than 14 million. The difference can come from the opportunity for the growth, the quality of the management team, the relationship with the suppliers, customers, which is links to the soft information of the company, which is not represented by the in the financial statements. So what is the ratio of market to book ratio? So we have 36 market cap value, 22.2 is the book value. So market to book ratio is 1.6. That says us, okay, it's the meaning of the market to book ratio is the value of the market in the stock market is higher than the book value of the company. That can signal us maybe this company is overvalued in terms of this ratio, overvalued because the investors giving more money or the pricing higher than the value of the company in the financial statements. Okay. Next question, problem 2, referring to global balance sheet. If Global has 57 million as total current assets and 34.7 million as total current liabilities in 2010, what is Global net working? What is the Global's net working capital? We simply take the difference between current assets and current liabilities, which is the definition of net working capital. We just take the difference and find 22.3. Okay. So problem 3, according to the financial information 2010, you look at the 2010 column and what is the company's quick ratio and what is the debt ratio. And again, we will use the quick ratio and debt ratio formulas, and we put the quick ratio. In order to calculate quick ratio, we are using the current assets minus inventory divided by 34.7. We find 1.20. And debt ratio is the total debt divided by total assets. We find 147.9 over 147, and we find 86% debt ratio. They are important. Income statement. The income statement shows the revenues and expenses of a firm over a period of time. It shows the firm's accounting profits or losses. It's not a summary of a firm's cash receipts and disbursements. So at the bottom line, I think you will find the net income, sales minus all expenses. Income statement, you will see we have net income. Let's look at only 2010. When you subtract cost of sales, we will find gross profit. When you subtract selling, general, and administrative expenses, R&D, depreciation and amortization, we will find operating income. And if the company has other income, we can add other income, and we will find EBIT, which is earnings before interest and tax. And we subtract interest income from earnings before interest and taxes, and we will find pre-tax income, and we will subtract taxes from pre-tax income, and we will find net income. So how can we find the earnings per share? So we will divide this value to 2 million divided by number of shares outstanding, and we will find earnings per share. And yeah, okay. Revenue, cost of goods sold, operating expenses, financial costs, tax expenses. Read the explanation. They are very straightforward. Again, depreciation, straight line depreciation, accelerated depreciation, and know how can we calculate straight line depreciation. This is the quick accelerated again, and of course, these ratios are very important. I strongly recommend you to read this calculations, gross profit margin, or operating profit margin, net profit margin calculations. These are very useful, very important, and also you don't need to memorize them. I summarize these ratios in a table, and you will find this table on the blackboard. Okay. Again, I will prefer to jump to the problem 4 to show this concept. So this is just a summary of all the ratios in this chapter, and we will find all the ratios from this chapter. So if you can solve this problem for this chapter, you're done. Given a global corporation's financial statements below, compute the following ratio at the year end of 2010. We will calculate those ratios, all of them. Gross profit margin, from gross profit margin until the times interest earned ratio, by using balance sheet and income statement. So you know the ratios. You don't need to memorize. You only need to find the sales and cost of goods sold. Find the EBIT, find the sales, find net income, sales, find the net income, and you should know where you can find sales. Sales comes from net income. Let's say EBIT comes from net income statement, or total assets come from balance sheet, so on and so forth. And you can easily find the ratios by finding the values from balance sheet and income statement. And problem 5, you can solve on your own. Cash statement. In each section, it enumerates the inflow and outflow of cash. Inflow of cash is decrease in assets, and asset increase in liability, and increase in equity. Outflow is an increase in asset, a decrease in liability, a decrease in equity. And DuPont identity, DuPont analysis is important. Know how can we use this analysis, and you will find again DuPont analysis probably, yeah. I'm checking the formula sheet. You probably have this anyway. So what is DuPont identity? So expresses return on asset as the product of profit margin, asset turnover, and measure of leverage. So what is profit margin? Net income over sales. What is asset turnover? Sales over total assets. What is measure of leverage? Total assets, total equity. So all 3 multiplication gives you return on asset. And this is just a simple multiplication. When you multiply these 3 concepts, it says just you just delete sales, total assets, and you will have only net income and the total equity. Okay, so calculation. I already explained this calculation on my recording. Please watch my explanation. And if you have any question right now, you can ask. on chapter 8 and 9. I think chapter 8 and 9 is very straightforward. And but again, if you have any questions regarding those concepts, please feel free to reach me out and ask me questions. I will answer you and explain the problems that you ask me. So thank you for today. Hope you see you next week. And I will meet you next week with you. Okay.